Good morning and welcome to the Saxo Bank Morning Call. It's Wednesday, January 16th, the day after last night's historic defeat of May's attempted deal that she tried to put together with the EU. The margin of the defeat was something on a historic basis, some talking about more than 100 years back, but clear to say that this was an unpopular deal, a real stinker, and this showed in the vote with only about half of the Tories, or a little bit more than that actually, voting in favor of the deal, and then very few Labour votes joining or crossing the aisle there. So if we look at our slide here, we can see that we have this historic defeat. What next? The idea is that we're looking at a confidence vote as soon as today, or I think it is actually already scheduled for today with Prime Minister May. The consensus is she will likely survive that vote, meaning that we will not see this new election scenario coming into view anytime soon. From here, does May go back to the EU and say, look, I have leverage now because of how resoundingly this deal was defeated, and try to renegotiate the terms with the EU? I somewhat doubt that the EU is willing to shift on its positioning. There's the idea that she could be launching some cross-party talks, but given the dysfunctional political atmosphere in the UK, I wonder how far these could proceed. And then we have the, I think, overwhelming consensus that we're looking for, and point number 5 there. The UK somehow, and possibly the EU, being quite amenable to this to avoid a crash-out Brexit, some sort of extension to Article 50. I wonder, it seems the consensus is rather overwhelming on that point, and I wonder if there is the risk that we see some sort of an actual no deal, but with a very long implementation period, and a no deal that transforms into some sort of a bare bones deal to soften the impact of the feared no deal terms. Regardless, I think also on the last point on that slide there, that second referendum scenario, I think looks very low. It's not at all popularly supported, and I think Parliament is very attuned to the popular demands from its constituencies. So that's where we are. The main thing for now is that sterling has rallied a bit, and we look at the slide here on euro sterling, where we're seeing that we're about 1% higher on sterling, or 1% lower on euro sterling, and trading around the 200-day moving average at the lowest levels this morning, cutting that trading range for the last many months exactly in half. It just shows you the ongoing uncertainty here, and I wouldn't expect that to clear up. Well, it actually could clear up fairly soon if we get a clear signal from what this end game looks like. And then broadly speaking, for now, risk appetite quite strong. We look at the S&P. We've that Chinese tax cut and the very strong response out of Asia there, seeing the S&P bulling into that next pivotal area. We talked about the 2600 area. This is where that rally in the S&P 500 stalled out. It's actually punched a little bit through there, and we've talked about a number of levels close to here. And I would argue the ultimate level for a reversal of the what looks like an incipient bear market is around the 2710 level, that 61.8% retracement. And Ola, if we look at the energy markets, we're seeing, we've argued that there's a lot of correlation across markets here, and oil being one of those barometers of risk appetite, as well as what are the prospects for the global economy. So what are we seeing here in oil?
Well, I saw a statistic yesterday which showed that the 30-day rolling correlation between the S&P and oil is the highest it's been for a number of years. So it does indicate that is as much what's happening outside the oil market that's driving it as what's happening within. But as you can see in the chart here, we stay above 50 here on WTI crude. We're boxing ourselves into this $50 to $55 range. Saudi's been out with some verbal intervention, being very optimistic about the cuts having the impact that they desire. The Chinese tax cut, as John mentioned, but also today we have the EIA report. As you can see in the forecast at the bottom, the API came out last night with forecasting a drop in crude oil stockpiles, and the EIA survey today looking for an even bigger drop. So that's all providing some underlying support. But still, the big themes, trade war, China, they remain unresolved, and at this stage, the upside, I believe at this stage, should be limited within this range.
What about Venezuela? I mean, we're seeing this opposition suddenly materializing that's a bit more prominent than what we've seen before. Is there any noise developing on Venezuela, at least for long-term prospects?
Only that for now the production in Venezuela is expected to drop even further as we move into 2019, potentially even below 1 million barrels, which is another couple 100,000 barrels lower than where it is now. So, but interesting that Trump may basically recognize the opposition as
also having Bolsonaro as a potential ally for some sort of gambit against Maduro. And very interesting developments there. Back to currency markets, the euro dollar is actually, it had ambitions above 115. I think a lot of that, or most of that, driven by the dollar CNY move as China moved to bolster its currency. That has since been rejected as we've gone quiet on dollar CNY as well. Dollar yen quite stable, not showing further dollar weakness there. And I think this last little bit lower here, further sort of underlining that rejection of the 115 attempted break, is on euro sterling being heavy in the wake of this Brexit deal. Nat Gas, we should have actually stuck on energy because we are also talking about natural gas, at least the U.S. natural gas prices, where we have crazy weather potentially.
Yeah, we like to talk about weather in any given time, but if you look at nat gas, you can see why the weather is really the big talking point right now. We had this very big spike up in November. We collapsed back down to 3, which was a bit of a consolidation. We talked about that last week, that it was that any renewed weather scare could potentially send the price higher. That's exactly what happened over the weekend. And you can see these gaps developing in the market. Longer term forecasts tend to be published over the weekend. That's why we quite often on Mondays have quite a strong reaction. So we had a drop on December 31st, and then on this Monday we spiked high again. You can see on the right there that we got a cold front once again coming down, hitting most of the U.S. east side on over the next couple of weeks. But the thing is, we basically need these cold periods to be sustained because we've got record production in natural gas. So as soon as the forecast just turns a little bit milder, gas comes down again because productions are at record levels.
Storage is assumed to be able to rebuild.
Yeah, and I just want to mention as an example, just to give the uncertainty right now. If you look at the February 3.5 straddle in natural gas, which expires in just 12 days. Yesterday that settled at $0.50, so basically a 14% move can be priced into. It needs to move more than 14% for that straddle not to yield a return. So that just indicates the uncertainty in the market.
And I assume you'll be talking a bit about natural gas later today. You have your commodities update webinar. Please sign up for that. We have that on the slide here. Energy quite prominent, and I guess gold.
Energy will be talked about. We'll talk about the gold, why the move we had up, why we think it's going to be potentially going to be sustained, and then we're just also looking at some of the other markets. Clearly, we're missing the cut report, so we haven't got any. We don't really see the direction right now from funds, so that's creating a little bit of a murky outlook. Also, especially for the grains, whether we're completely lacking data.
Right. And that's also affecting U.S. economic data in bits and pieces as well, but not affecting the earnings calendar. We have a bit of an overview here of the big reporting companies in the U.S. as the Q1 earnings season getting into full swing. We've got Bank of America and a couple other banks out this morning ahead of the market open, and then maybe an interesting one for non-financial sector being the CSX reporting aftermarket. That's a big railroad in the U.S. And you see the other names down at the bottom. Netflix, a bit interesting there. They've come roaring back from recent lows, and also in light of their subscription and announcement to increase their subscription costs. So a big change in sentiment there. As there has been across the board, a risk appetite, not just in equities, but if you look at lower quality corporate debt, it's come roaring back as well. But what we can show you on the U.S. economic calendar and other global economic calendar front, on our calendar for today, we have the UK CPI up today. I think the market obviously is trying to digest Brexit situation more than anything else. That January NAHB housing market index out of the U.S., I've highlighted that because this is one of the better leading indicators on the U.S. housing market. We've got weekly crude oil inventories as well, and then the beige book later, maybe giving a bit of a further spin on the Fed's impression of how things are going in the U.S. economy as well. Last item there for today, that UK RICS house price balance has turned quite negative. UK housing could come under considerable pressure, or is under considerable pressure, and the degree to which that continues is quite interesting here. The rest of the week I won't highlight too much, but just keep your sight on the dollar CNY. In terms of the market situation, and I think the U.S. government shutdown is getting to the crunch point in terms of where it takes the U.S. economy and sentiment if it continues much past today with no signs of Trump standing down from his position. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.